Whole life insurance is the worst place to put money. Banks, corporations, and millionaires and billionaires put tons of money into cash value life insurance. So how can both be true? You're going to see this cash value grow by 5%, you'll have millions of dollars, but then in reality, the product underperforms. I've seen this happen so many times, especially cases where the illustration projected a 5% growth rate over 20 or 30 years, and then it ended up delivering 2%. Yeah, that's a great way to have someone hate whole life insurance. If you've watched our channel for any time, you know we talk a lot about the benefits of high cash value life insurance. But in this video, I'm going to flip things. I'll walk through the main drawbacks of using whole life insurance, specifically for the cash value. Now, this is coming from someone who actually sells and designs these policies every single day. We're going to stay focused on the cash value side of things, though. I'm not going to get into the term versus whole life versus investing debate. Everything has its place. But this video is specifically if you want cash value and you want to understand the downsides before you start a policy. So why this even matters is because online, you'll usually see two extremes. The first is that whole life insurance is the worst place to put money. Just buy term and invest the rest. And the second is that banks, corporations, and millionaires and billionaires put tons of money into cash value life insurance. So how can both be true? Well, it's because they're usually reacting to two different types of policy designs. A poorly designed policy is a horrible place to grow cash value, whereas a well-designed policy set up for maximum cash value is a way different animal. So let's hit on the actual drawbacks, and this will help you see where this disconnect comes from. Drawback number one, it takes time to capitalize. When you first open a life insurance policy, regardless of the dollar amount that you pay in, you are going to see less in cash value than what your payment was in the first year. So I'll give you a quick story about this phrase. Very early on in my career, I had worked at an office, and a doctor named Doug came in and he wanted to put $100,000 per year into a whole life insurance policy. He met with the owner of the firm and another agent, and he was interested in a policy mainly for cash value. But they sold him a policy where his first year cash value was zero. And this office sold everyone policies like that. I remember one person during a meeting asked the owner of the firm, hey, if this is a high cash value policy, like where's my money? And the owner's response was, you need to capitalize the policy first. And I've heard this countless times from various individuals over the years. Here's the thing. You don't have to have zero up front. You can actually have the majority of what you pay into the policy up front and see a positive gain very, very early on. The thing is that policy design is absolutely critical. So let's assume you want a whole life insurance policy and you're going to fund $20,000 per year. And you're given three options, but they're all with the exact same insurance company. Option A has all of your $20,000 going toward what is called the base premium, which this, by the way, is the most common type of whole life insurance design that is set up for consumers. About 90% of whole life insurance policies have all of their money direct going toward the base premium. So what you would see in a case like this, with everything going toward the premium, is your cash value in the first year would be about zero. And it would take between 10 and 15 years to capitalize that policy. Now, what I mean when I say capitalize is it would take that long to break even or see a positive return on your cash value. That's option A. Option B is the same product where you pay the same $20,000 per year, except $10,000 is directed toward your premium, and the other $10,000 is directed toward your PUA rider, which stands for paid up additions. I like to call this a cash dump-in. So the difference with this, if you're laser focused on the cash value, is the first year you would have $10,000 instead of zero. And instead of taking 10 to 15 years to get your money back, you get your money back between 7 and 10 years. So option B is much more attractive if we're focusing on cash value. But then here's option C. You pay the same $20,000 per year, but your premium is about $1,800. Then you also add what's called a term insurance rider. That might cost you $200. And when you add those two together, it's $2,000. The other $18K goes toward your PUA rider. Now, your cash value in the first year is $18,000, and it only takes 3 to 5 years to capitalize the policy. Here's a quick example of exactly that. So, to the left, you've got option A, where the full $20,000 goes toward the premium, and as a result, you have zero in cash value. Next, we've got option B, where you still pay $20,000, but $10,000 goes toward the premium, and $10,000 goes toward the PUA rider. You've got a little bit less than $10K in the first year. And then we've got option C with a $2,000 minimum premium, which includes both the base premium and the term insurance rider we have attached to the policy, and the other $18K is going toward PUAs. So same out of pocket and cash value, about $17,500 right out of the gates. If you look at the capitalization phase, or the break-even point, you'll see a huge difference. How you can find that is by looking at the total funding columns. So, back to option A, how long does it take to capitalize this policy? Well, by year 13, you've paid $260,000 and you've got $258,000. That's still less than what you paid. It is not until the 14th year that you finally see more in cash value than what you have paid into the policy. If you look at the second option, it's the 10th year, where I have paid $200,000 and I have just north of $200,000. And then if I look at option C, way more attractive, where it's by the 4th year, I've paid $80,000 and I have more than $80,000. Long term, option C gives you a lot more cash value as well. What's the lesson here? Make sure the policy is set up for maximum cash value, because the drawback typically comes into play when someone is not aware that they could have a policy that has rich cash value up front and rich cash value long term. The second drawback, having a big premium commitment, especially early on. So with a life insurance policy, the base premium is what is required to be paid. It also is what causes the upfront hit. Base premium dollars buy life insurance first, and I do not see them show up in cash value initially. Whereas PUA dollars are very flexible. With some companies, you can add money toward your PUA rider whenever you want, and it's also optional to add. Meaning if we go back to that $20K per year example, I'm only committed to $2,000, and then some years I might add an extra $5K into PUAs, other years might be 10. I can add when I want. So it makes it function more like a flexible savings asset instead of a boring bill. But back to the premium, if you go with a big premium and life happens, meaning your income takes a hit, or you had to use your savings on something else, what happens when that premium is due and you can't pay it? Well, A, you have to pay it, or B, you need to have enough cash value in the policy, or the policy needs to be producing enough in dividends so it can cover that premium for you. If the premium is too high, this is where people often feel like the product is a burden. Now, I see this a lot in the infinite banking space, particularly behind the argument of going with a higher base premium. And the logic behind this that I'll often hear is if you go with a higher base premium, it gives you the ability to fund for a longer period of time. That's why you want a higher base premium. Or you want to build in more capacity so you can fund more as the years pass. That's nonsense. Like, you can design a policy however you want with almost any size base premium. And if you follow the money and look at what corporations do, corporations that want to fund policies for a short number of years or for a very long time, they are always maximizing the cash value as an asset on the balance sheet, upfront and long term. That base premium is pushed as low as the insurance company will allow, which is often a 10% minimum. So the big drawback to having a big premium is one, if life happens and I can't pay it, A, the policy must have enough cash value to cover that premium for me. And then B, the higher the premium, the higher the upfront hit and the longer the capitalization phase is. And drawback number 3, realistic expectations on the cash value growth. So a big problem in the life insurance industry is that illustrations often look fantastic on paper. You're going to see this cash value grow by 5%, you'll have millions of dollars, but then in reality, the product underperforms. I've seen this happen so many times, especially cases where the illustration projected a 5% growth rate over 20 or 30 years, and then it ended up delivering 2%. Yeah, that's a great way to have someone hate whole life insurance. So how do you prevent that? Because that's often outside of our control if the insurance company is controlling the crediting method. Well, there's 2 things that you can do that I have seen consistently produce the best overall results in terms of cash value growth, meaning the highest returns. The first is go with a proven company. So when I look at proof of performance with whole life insurance policies and companies that can show that proof on a consistent basis, I've seen it from 4 companies very, very consistently over the years. Those 4 companies are MassMutual, Guardian, New York Life, and Northwestern Mutual. The second thing I would do is go back to policy design. Absolutely critical. So if we look at another example, but we're going to look at the exact same insurance company here. This will be a MassMutual example. We're going to look at the same out-of-pocket going into a policy, but we're going to focus on the year 20 internal rate of return. So option A will be that 100% base premium example. When we look at the internal rate of return at year 20, it's going to be about 2%. Option B will be a 50-50 split. 50% premium, 50% PUA, year 20, a 3.5% IRR. And if we juice the policy, looking at option C with a 1090 design, so 10% premium, 90% PUA, now we'll see a 5% internal rate of return. So let's take a look at the actual illustrations, shall we? So here we go. To the left, we've got option A, 100K per year with 100% of the payment going toward the base premium. When we look at the cash value, he puts in a total of $1 million. First, it takes 15 years to get his money back. And then by year 20, the internal rate of return is just over 2%. Why it's so low is because he had to make up for this big hit during the early years. Now, if we look at the same product here with a 50% premium and 50% PUA, because we're allocating more money to the cash value, we reduce that upfront hit, and long term, we've got more money. Still horrible in my opinion. I would not do this. But then when we look at option C with that 10% minimum premium, it's actually closer to 8% all in with the premium and term rider. Check this out. 1, you're almost cash positive in year 3. You are positive in year 4. And then by year 20, your IRR is more than 5%. So what we did here is set the policy up to have as much cash value as possible from start to finish. With a design like this, you'll also have more money when you're looking at the guaranteed cash values. So whenever someone compares a bad policy design to the strategy of buying term and investing the rest, the buy term and invest the rest is going to look a lot better because the comparison of the whole life product is junk. It's designed with all premium. It takes forever to generate anything meaningful. Where whole life insurance often wins, though, is when I'm approaching the cash value, 1, with a properly designed policy, but I'm looking at the cash value as a safe, conservative, long-term place to store money. It's liquid, meaning I can get to the money anytime I need it, and I've got a really sweet tax advantage, being that it's tax-free, provided I follow IRS rules. And also, when it comes to the death benefit, that's also paid out income tax-free, which can be used for legacy and estate planning purposes, which is nice. So one thing I will say is if you need to double your money fast, this is not for you. A big drawback to a whole life insurance policy is looking at the time horizon and the fact that it does grow slow and steady as the years pass. So I would approach it with realistic expectations. So who shouldn't do this? Well, first, if you're barely covering your monthly bills and you have no savings buffer, I wouldn't do it. If you need money in the short term and you can't afford to take that hit up front, I wouldn't do it. Or if mentally you look at that illustration and you see I put $1 in and at best I've got 90 cents on my dollar, it doesn't work for me and I've got to wait 3 to 5 years to get my money back. If you feel like that, I wouldn't do it. A cash value policy works very well for people with stable or growing income. They want a safe, liquid, tax-free place to put some of their money, and they're also okay with taking that short-term hit in order to get the long-term stability and option to borrow against their policy like their own bank. But regardless, the design is probably the most important thing. Make sure that the policy is designed to have as much cash value up front that'll minimize that hit, and you'll see more cash value from a long-term perspective as well. So if you already have a policy and you're wondering, did I get one of the good designs or did I get a bad one? Or if you're thinking about starting a new one and you'd like to see the drawbacks and you'd like to see numbers for your own situation, that's what our company does every single day. So we can look at your existing illustration if you have a policy in place, or we can build out a new one for you. We'll go over exactly how long it'll take to break even, the realistic long-term growth rate of the policy, and also what your true minimum premium is. So if that sounds good and you'd like to see an example, I included a link in the description below, and you can request a meeting with us, or we can prepare illustrations for you when we connect. Thanks so much for watching, and I hope this helps.